Imagine walking out to your mailbox on a perfectly normal afternoon, flipping through grocery ads and utility bills, and then spotting an official envelope from the IRS. Your stomach tightens a little. You open it, expecting maybe a routine notice. Instead, you're staring at a penalty, $10,000, and the worst part, you have absolutely no idea what you did wrong. You didn't hide money overseas, you didn't run a secret business, you didn't cheat on your taxes. All you did was deposit some cash from selling your truck, or maybe your daughter gave you money to help with medical bills, or you moved funds around to finally replace that old roof. Completely normal retirement activity. But in 2026, normal doesn't always mean safe. Because what's triggering these penalties isn't criminal behavior. It's patterns. Patterns flagged by automated systems that don't know your story. And once that system decides something looks suspicious, the penalty can start at $10,000 for a single violation. Today, we're going to unpack exactly what's happening, why so many retirees are getting caught off guard, and the one simple mistake that can turn an innocent bank visit into a federal problem. Hi, I'm Timothy, and I spend my time helping retirees protect the nest egg they worked an entire lifetime to build. And I need to talk to you about something that has quietly changed in the financial world this year. The rule itself isn't new. In fact, it's been around for decades. But the way it's being enforced in 2026 is completely different, faster, automated, and far less forgiving when something doesn't line up perfectly. My goal today isn't to scare you. It's to make sure you understand what's really going on, what kind of everyday bank activity can trigger a massive penalty, and most importantly, how to protect yourself so you never experience that $10,000 surprise. Because once you see how this works, you'll realize the danger isn't obvious. And that's exactly why we need to talk about it. So, let's start with the part that's catching people completely off guard, the everyday transactions that look totally harmless on the surface. Picture this. You sell your old pickup truck for $15,000 in cash. The buyer shows up, counts it out, and you head to the bank to deposit it. Simple. Or maybe your son wires you $20,000 to help cover some unexpected medical expenses. Or you finally take that lump sum pension payout you've been thinking about for years, or you move a large chunk of savings from one account to another because you're putting a down payment on an RV. None of that is illegal. None of that is shady. It's just life. It's retirement. It's your money. But here's where things start to shift in 2026. Banks aren't just holding your deposits. They're reporting certain types of activity automatically. And those reports don't sit in a filing cabinet somewhere collecting dust. They're being scanned, sorted, and cross-referenced by systems that are designed to find inconsistencies. So, when a large amount of cash suddenly appears in your account, the system doesn't see truck sale or gift from daughter or retirement payout. It sees numbers, it sees patterns. And if those patterns don't match what's on your tax return or other financial records, it raises a digital eyebrow. This is the part that feels unfair to many retirees because from your perspective, you're just managing your finances responsibly. But from the system's perspective, it's asking one very specific question. Where did this money come from? And was it properly reported? And if the answer isn't crystal clear in the data it has access to, that's when problems can start. Now here's the twist that surprises almost everyone. The rule behind all of this isn't new, not even close. In fact, it's been around for decades. What's changed is how aggressively, and how efficiently it's being enforced. At the center of this is something called a currency transaction report, or CTR. And despite how intimidating that sounds, it's actually very straightforward. By law, banks are required to file a CTR anytime someone makes a cash transaction over $10,000. That includes cash deposits, cash withdrawals, even certain types of transfers. So if you walk into your bank and deposit $12,000 in cash, the bank fills out a form and sends it to the government. You don't fill it out. You don't even necessarily see it. It happens behind the scenes. And here's what's important. A CTR is not a penalty. It's not an accusation. It's not a sign you did something wrong. Millions of these reports are filed every year. For decades, this has been routine. Business owners deposit cash. People sell cars. Families move money around. The bank files the form, and life goes on. So, if that's been the law for years, why are retirees suddenly hearing about $10,000 penalties? Because in the past, these reports mostly just sat there unless a human investigator had a reason to look closer. Today, that's no longer the case. Now, those CTRs are instantly fed into automated systems that compare them against tax returns, social security records, pension distributions, and other financial data. The system isn't just collecting information anymore, it's analyzing it in real time. And when it finds something that doesn't line up, that's when the trouble begins. But there's another layer to this, one that's even more dangerous than a simple large deposit. It's a mistake that well-meaning people make all the time, thinking they're actually being smart. And in the eyes of the IRS, that single decision can turn a completely legal transaction into a federal violation. That's what we're diving into next. Here's where everything changes, and where a lot of honest, law-abiding retirees accidentally step into dangerous territory. Let's say you have $12,000 in cash. Maybe it's from selling a boat. Maybe it's savings you kept at home. Maybe it's money you've had for years and just never deposited. You walk into the bank, and right before you step up to the counter, a little voice in your head says, "If I deposit all of this at once, they'll report it. I don't want any extra attention." So instead, you deposit $8,000 on Monday, then you come back Wednesday and deposit the remaining $4,000. From your perspective, that feels harmless, responsible even. You're not hiding income, you're not dodging taxes. You just don't want paperwork filed with the government. That seems reasonable, right? But in the eyes of federal law, that decision can completely change the situation. This is something called structuring. Structuring happens when someone intentionally breaks up a large cash transaction into smaller amounts for the purpose of avoiding that $10,000 reporting requirement. And here's the part that catches people off guard. The money itself doesn't have to be illegal. It doesn't matter if it came from your pension, the sale of personal property, or a gift from family. If the deposits are split specifically to avoid triggering a currency transaction report, that action alone can be considered a federal violation. And yes, penalties for structuring can start at $10,000 per violation. Now let's contrast this clearly, because this is critical. If you walk into the bank and deposit $12,000 in cash in one single transaction, the bank files a CTR. That's it. Routine, legal, no crime, no penalty. In most cases, nothing further happens. But if you intentionally deposit $8,000 and then $4,000 specifically to avoid that report, you've just created a pattern that automated systems are designed to detect. And those systems are very good at spotting patterns. They look at timing, they look at amounts, they look at sequences of transactions over days or weeks. If it looks like the deposits were structured to stay under the reporting threshold, that's when red flags escalate quickly. And here's the uncomfortable truth. The system doesn't read your mind. It doesn't know you were simply trying to avoid extra attention. It only sees the pattern, and the pattern is what matters. This is where so many good people get into trouble. They think they're being cautious. They think they're staying off some imaginary radar. But in reality, breaking up deposits to avoid reporting is exactly what puts them on the radar. Let me say this as clearly as possible. Filing a currency transaction report is not a problem. Trying to avoid one can be, and this is the shift happening in 2026. With advanced automation, cross-referencing, and real-time analytics, these patterns aren't slipping through the cracks anymore. The system doesn't need a human investigator sitting at a desk. It flags inconsistencies instantly. It connects deposits to tax returns. It compares reported income to cash activity. And when something doesn't line up, notices go out automatically. Now, before you let this spiral into anxiety, take a breath. The IRS is not targeting retirees who are simply managing normal finances. The overwhelming majority of people who deposit money properly, even large amounts, never face an issue. The real danger is misunderstanding the rule. So here's the first major takeaway. Never split a transaction just to stay under $10,000. If you have more than $10,000 in legitimate cash deposited in one transaction, let the bank file the report. That's what the system expects. That's what keeps everything clean. If this is already helping clarify things for you, take a quick second to like the video and subscribe. I share updates like this specifically to help retirees avoid expensive mistakes before they happen, not after. Because now that you understand structuring, we need to talk about something just as important: how to protect yourself moving forward. What simple habits can make sure that even in this fully automated IRS environment, you're never caught scrambling to explain your own money? That's exactly what we're covering next. Now that you understand where the real risk is, let's shift from awareness to protection. Because this isn't about panic, it's about preparation. The enforcement environment in 2026 may be more automated, faster, and less forgiving of inconsistencies. But the way you protect yourself is surprisingly simple. It doesn't require complicated legal strategies or expensive loopholes. It requires organization, clarity, and a paper trail. So, here's the first step, and honestly, this is the most powerful one. Document everything. Anytime a large sum of money moves in or out of your accounts, you want records that clearly explain where it came from. If you sell your car for $15,000, keep a signed bill of sale, make a copy, scan it, store it somewhere safe. If your daughter gives you $20,000 to help with medical expenses, ask her to write a simple gift letter stating the amount and that it's a gift, not income or a loan. If you take a lump sum pension payout, keep the distribution paperwork. If you withdraw cash for a large purchase, keep invoices and receipts. The goal is simple. If anyone ever asks, you can immediately show the source and purpose of the money. Because here's what most retirees don't realize. The IRS computer doesn't automatically know the context of your transactions. It sees numbers. Your documentation provides the story behind those numbers. And when the story is clear and supported by paperwork, issues tend to resolve quickly. Step 2, if your financial life is more complex than just Social Security and a small pension, this is the year to sit down with a qualified tax professional. A good CPA doesn't just file forms. They help make sure your tax return tells a complete, consistent story. If you had a large deposit from selling property, that needs to align with what's reported. If you received a sizable gift, they can help ensure everything is documented properly. Automation flags mismatches. A tax professional helps prevent them before they happen. And step 3, communicate openly with your bank. This one surprises people. There's no harm in asking your bank about their reporting policies. In fact, transparency works in your favor. If you're planning to deposit a large amount of legitimate cash, you can simply do it properly and let them file the required report. Remember, a currency transaction report is routine. It's not an accusation. Trying to avoid it is what creates risk. When you combine these 3 habits, documentation, professional guidance when needed, and transparency, you dramatically reduce your chances of ever facing that $10,000 surprise. Let's pause for a moment and put this into perspective. The automated systems in 2026 are powerful. Yes, they connect dots instantly. They cross-reference deposits with tax filings. They identify patterns humans might miss, but they are still data-driven systems. They rely on consistency. When your records are organized and your transactions are straightforward, you're operating exactly the way the system expects. This isn't about hiding, it's about clarity. And if you know another retiree, maybe a friend, a sibling, someone in your community who still thinks breaking up deposits is a smart move, share this with them. A simple misunderstanding could cost someone $10,000 or more, because the truth is, the financial world has changed. The old way of doing things where small inconsistencies might slip by unnoticed is fading fast. We're now living in a fully digital enforcement era, and the people who adapt early are the ones who avoid unnecessary stress. Which brings us to the bigger picture. Here's the bigger picture you need to understand. The enforcement shift we're seeing in 2026 isn't temporary. It's not a pilot program. It's not something that's going away next year. Automation is now embedded into how financial oversight works. The systems are faster, they're more connected, and they're designed to operate continuously in the background. That means the retirees who are most at risk aren't the ones doing anything criminal. It's the ones operating under outdated assumptions. For years, many people believed that if something didn't immediately raise eyebrows at the bank, it probably wasn't a big deal. If you kept deposits small, stayed under the radar, or handled things quietly, you were being cautious. But in today's environment, trying to stay under the radar is exactly what creates the radar signature. That's the irony. One straightforward $15,000 deposit with proper documentation. Routine, logged, processed, forgotten, multiple smaller deposits made intentionally to avoid reporting, pattern detected, flag triggered, questions generated. The system isn't emotional. It doesn't assume guilt, but it does assume that patterns meant to avoid reporting deserve scrutiny. And once that scrutiny begins, it can be stressful, time-consuming, and expensive to resolve. Now I want to ground this in reassurance. Most retirees watching this will never face a structuring penalty. Most large deposits, when done properly and supported by records, pass through the system without incident. The goal here isn't to make you nervous every time you walk into a bank. The goal is to replace uncertainty with clarity, because clarity changes how you act. When you understand that a currency transaction report is normal, you stop fearing it. When you understand that structuring is about intent to avoid reporting, you stop accidentally creating risky patterns. When you understand that documentation tells your financial story, you start keeping the kind of records that protect you automatically. This is really about mindset. The old mindset was keep it quiet. The new mindset needs to be keep it documented. That single shift can save you enormous stress. So here's the question I want you to seriously consider. If a fully digital IRS system reviewed your last 12 months of financial activity, would the story make sense on paper? Would every large deposit have a clear explanation? Would every movement of funds align with what's reported on your tax return? If the answer is yes, you're operating exactly where you need to be. If the answer is, I'm not sure, then now is the perfect time to organize, to file paperwork properly, to scan documents, to sit down with a tax professional if needed, and to clean up anything that feels unclear. Not because you're in trouble, but because preparation is far less expensive than penalties. You worked decades to build your retirement savings. You sacrificed, you planned. You made careful decisions so you could enjoy this chapter of life with security and peace of mind. The last thing you want is a preventable $10,000 penalty because of a misunderstanding about how bank reporting works. The rules themselves haven't radically changed. What's changed is the speed, the visibility, and the automation behind enforcement. And the retirees who thrive in this new environment aren't the ones who panic. They're the ones who adapt. So deposit large amounts properly. Never split transactions to avoid reporting. Keep documentation for significant financial events. Make sure your tax return reflects your reality, and treat transparency as protection, not exposure. Because when your financial paper trail is clear, organized, and consistent, automated systems have nothing to question. And that's where peace of mind lives.